Hello, everyone, and welcome to another episode of Financial Advisors Want to Know. I'm Catherine Tindall, a CPA with Dominion, specialty tax and accounting firm for financial advisors. And on today's episode, I have with me Mitch Cooper. Mitch is a reverse mortgage advisor with Mutual of Omaha Mortgage as a CRMP, a certified reverse mortgage professional. Say that 10 times fast. And CRPC. Mitch educates financial professionals on the use of home equity in retirement, which is going to be the subject of today's conversation. And we got connected because Mitch was speaking at FPA NorCal, and I couldn't make it this year. I spent part of the year in California. And we connected over LinkedIn because I was interested in what he was doing and learning about that. But I wanted to invite him onto the show to have this conversation because as a tax professional, reverse mortgages are something that we totally just don't even deal with on a very frequent basis at all. And I think for financial advisors, it's just not really a topic I hear talked about very much.
Sure.
So I would love to just go into maybe the Cliff Notes version of what you think advisors should be knowing about this process, and maybe starting off with, ignoring housing wealth and retirement, and what you see advisors miss around, the opportunities with these reverse mortgages.
Yeah. Well, first, thank you for having me on. I'm always happy to educate and, share in any way that I can. My biggest, my soapbox that I'm always on is ignoring housing wealth.
Mhm.
When we look at the median retiree, 2/3 of their wealth is their home. So you look at their assets and their housing wealth, their equity in their home is double of all their remaining assets. And that's significant. And housing from a retirement income planning perspective is not really a great asset. It's really illiquid. It has high transaction costs to get that money out. One of the biggest things is the deep emotional connection that clients have to their house. You can't, clients are probably not questioning which stocks you're selling to create their RMD. You probably have the 1 in 100 that is maybe, but most of them don't care. But if you were ever suggested, hey, it looks like we're going to need to sell your house, we need more liquidity, that's probably a conversation with tears, right? If they're not
Mm.
already looking to downsize, that's a big deal. And so from a retirement income planning perspective, housing has a lot of disadvantages, yet it's 2/3 of their wealth. I mean,
Yeah.
it is just a massive chunk. And so we need to start talking about that because it's not something we did intentionally. We weren't looking at their asset allocation and figuring that, 66% housing wealth is the ideal efficiency curve of risk. This just happened
Yep.
because for a
Yeah.
lot of reasons this has happened, but it wasn't intentional. And so what are our other options, and how can we make this look a little different for the retiree is the biggest key to start investigating things like reverse mortgages as another tool.
Yeah. And I guess, I think probably one of the more common blocks, like I was just looking at a post yesterday about people going through retirement planning, but then not planning like their long-term care, and also not
Mhm.
planning for their basically the increased emotional needs that they're going to have post-retirement, and just not planning around that. And
Mhm.
how you're bringing this up with the housing wealth, like, this is the same thing, right? It's a hidden thing. A lot of people just,
Yeah.
advisors just ignore it and then move
Yeah.
straight into those, out, like, let's change around your portfolio distribution. But so how do you even so you have say you have a client where they've got this situation going on, and you're like, "Ugh, we're going to have the downsizing conversation." Maybe how do you get into that initial conversation with them, and how do you frame up the benefits of, okay,
Mhm.
there might be another way to deal with this? Like, how do we work through this issue that you're going to be, and I think this is going to be an issue that's more and more and more common, especially with the
Mhm.
current generation of, it is so much of their wealth is that house, and you had kids and then you're not in the house anymore and you have to downsize and maybe you don't want to. How do you go about framing the benefits of the different options that they have? And
Yeah.
then maybe we can talk a little bit about the, emotional intelligence side of it, but in terms of just financially, like on the modeling side, what
Mhm.
what should the advisor be looking at before
Yeah.
initiating that conversation?
One of the things I think there is so much lack of understanding of what the modern reverse mortgage can do, what it's capable of, and in the situations that it fits in, It is really more of a multifunction tool.
Hmm.
Client A, client B, client C, so reverse mortgages will look very different. It's all ultimately the same product. I think one thing that people don't realize is 95% of today's reverse mortgages are an FHA loan.
Hmm.
They were put in place by Congress, and they're insured by the FHA, and they make all the rules. So I think most people, that's where you get like the kind of, oh, they're a scam and they're taking your house. You're like, well, okay, Congress put this in place. So not to say they got everything right out of the gate. It took them some time to fix some issues that they didn't foresee. But it really is a multi-function tool. And so we adapt it to each client. And like you said, I think you hit it. It's just another option. It's not going to be the option for everyone. It is actually pretty limited in what it's allowed to do for some of those people, especially if they've already spent all their other assets.
Hmm.
It gets much harder. But so there's a lot of different ways that we utilize it. I think the best way to frame it is it's another option, right? So we
Hmm.
know we can do a home equity line of credit. We can maybe refinance and do cash out. We can sell and downsize. Those have historically been the only three options. Kind of anecdotally, I've seen a lot of early retirees start to get in trouble and they pull out that home equity line of credit, right? This is
Hmm.
kind of start to backstop the over withdrawal of their portfolio, or running out of money at the end of the month. And it can work. A home equity line of credit's a great tool, fits a lot of needs. It's very inexpensive. The problem is that we've seen in recent years interest rates doubling in a very short time. So you have adjustable interest only payments. So we've seen payments jump up on retirees. They're typically 10 years of interest only and then a 20-year amortizing loan. And so that most clients underestimate their longevity. So they usually play the, well, I'm not going to be here in 10 years card.
Hmm.
And it turns out a lot of them do make it to that point, right? And
Yeah.
so now
Yeah.
you have a payment that's jumping up again. So it can work, but this is an option that was really designed for retirement, right? This is
Hmm.
a retirement product that FHA put in place to help retirees. And so when you have a product that was designed for this purpose, it tends to meet the needs a lot better, right? So, and ultimately, to boil it down, our goal is to add liquidity and cash flow.
Yeah.
Those are the two goals: add some liquidity to that asset without liquidating the asset, right? The housing is a weird asset in that its main purpose is a consumption good or a lifestyle good, right? It's there for the shelter over our head, but also the lifestyle that comes with it, whether that's the golf course home or the lake or near your grandkids. That's ultimately what people are buying. Yet it increases in value, and so it's one of the only consumption goods that does that, and so that it becomes a financial asset. And that wasn't the main goal. So it's this weird thing where we have kind of two purposes of it. And so we're trying to access some of that financial asset piece without changing the consumption good or lifestyle good. We're not cutting the home in half. We're not taking ownership of the home. It's still their home. They can still have their grandkids over. They can still have their wine parties on the back deck. It's their home. Nothing has changed about the asset. And we're going to start to access it a little bit as a financial asset and start to get to draw down that wealth instead of drawing down the IRA only, and start to use some of that financial asset that's most of their wealth.
Yeah,
Yeah.
that's great. And because I'm guessing this is probably a good midterm option when people aren't ready to do the downsizing, but they still need to tap into some of that liquidity. And then once you get to the point of, okay, we're accelerating in age, we need a single story place, we need to be near assisted care, whatever it is, like that real downsizing that happens. This used more like as a midterm option
No,
between
not
that or
necessarily. It works best as their last home.
okay.
So ideally it's their last home. So that's one of the the minimum age for the FHA product is 62. One of the spouses has
Okay.
to be 62.
Hmm.
But on average our clients closer to 74. And I
Okay.
think the biggest reason for that is 62 is very young
Hmm.
to feel like you're in your last house.
Hmm.
Even a lot of 62-year-olds will tell us, yeah, this is my last house. And 10 years later they move. So it's just young. 62-year-olds are still working. 60 is the new 40, right? So
Hmm.
it's a very young client to kind of really know where they're going to be. Kids are maybe, adult children are still landing where they're going to land. And, moving closer to family is the number one reason retirees move. So kind of where are they going to end up and that kind of thing. So, but you never know if it's your last house. It doesn't have to be your last house, but ideally that's where it's going to work best. But you are right in that it also works way better if we put it in place before they need it.
Mm-hmm.
Ultimately, the analogy I like to use is if you think of retirement as a road trip, and you're setting out, you've saved up all your fuel. You can put as much fuel in there as you want while you're working, and then at that point, after you have your set amount of assets, and you're starting to draw that down, and you kind of have to figure out, am I taking an RV that gets 3 miles to the gallon but ultimate luxurious lifestyle, or am I taking a Prius where there's no room but I can make my money last a long time? In the advisor world, in the retirement income planning world, we use a percentage. The withdrawal rate is kind of that factor, because it kind of equalizes all things. If you're spending it at 9% withdrawal rate, doesn't matter how much money you have, that's a lot, versus a 4% or 5% or something more realistic that can actually last a long time. And so the reverse mortgage we utilize to help miles per gallon, right? We help bring down the withdrawal rate. And so that works a lot better when there's still fuel in the tank. If you're out of gas and we go, hey, now you have 40 miles to the gallon instead of 10, you're out of gas. It doesn't matter how much
Yeah.
efficiency. And so the earlier we put that efficiency in place, the better and more effect it has. And so our goal is to make the RV have more of an SUV miles per gallon, or have the normal SUV have more of a hybrid miles per gallon. So we try to extend the current lifestyle and make it more efficient, or increase the lifestyle and keep the same efficiency is the goal. And so the sooner we do that, the more assets that are in place where we can stop drawing so much on the IRA and utilize housing wealth throughout retirement, the
Mm-hmm.
better it does, and the more sustainable and longer longevity that we can create.
Hey there, Catherine here. Thanks for listening to the conversation. Just wanted to explain a little more about what we do. So, I'm a CPA here with Dominion. We're a tax firm that works specifically for financial advisors as they're growing and scaling their practices to help them avoid tax waste, make the right calls, and grow practices that they love. So, if you're interested in saving more, you can DM me on LinkedIn with the word guide, and I'll send you over our guide for financial advisors to scale tax efficiently. All my top tips to unlock six-figure savings. Thanks, and keep enjoying the show. Yeah, and I guess one question I have, I'm not even going to bother trying to get into the tax implications on this, because that will
It's a
be,
fun one.
yeah, because that would be, I think, a whole separate episode of going through, basically trying to game how you're doing this from a tax perspective, because it's a different category compared to, if you're just taking regular distributions, like in getting hit with income tax on it. But I guess something I'd be interested to hear you talk through is maybe an example of like an ideal situation with a couple of figures, and just like a ballparky thing, just
Mm-hmm.
to kind of work through for somebody to have like in their mind, like, okay, if client who looks like this walks into the office,
Yeah.
this is kind of what the process would look like. What should they look like, in
Mm-hmm.
terms of characteristics that they have going on, age, and then what's the general Christian,
Yeah.
story arc of how the
Yeah.
process works, because I think that would be a nice thing to hit if you want to
Yeah.
go through
Yeah.
that
So
a
like
little
I
bit.
said, it's a multi-tool. So I'll pick kind of my favorite client to work with, or scenario that I think really has the max benefit. So if you picture, it's really that client that is okay as long as nothing goes wrong,
Hmm.
right? So, they're doing all right. There's no spending issues today. Maybe they're even RMD only. We're okay. But if he passes in the next 10 years and we lose his pension, we might be in trouble.
Hmm.
Or, if we have any sort of significant long-term care event, we're going to be in trouble, and that kind of a thing. And we're gonna have to sell the house, and that kind of thing. It's really the client that is fine, does not have an immediate need, but that rainy storm, or one thing goes wrong, and now it could look very different,
Hmm.
and has significant housing wealth. Ideally, is maybe free and clear.
Hmm.
And so they're free and clear. I have clients that were in this exact scenario. It's very much just what happens if one of us passes, because we both have the social security income, and if one of us passes, that changes the picture, and we're not really sure we can stay here, and we love it here, and that kind of a thing. But they're free and clear, $700,000 house. They're both I believe 70 or 72, and so and in good health and everything like that. All we did was, this is where the reverse mortgage is most similar to like a deferred annuity. So we're going to use the home, and we're just going to set up what an annuity would call a benefit base. In the reverse world, it's a line of credit, similar to a home equity line with some significant differences. And so one is, reverse mortgage from its simplest perspective is just a mortgage that doesn't require a monthly mortgage payment for as long as one of them's there. So it's a line of credit they could draw on, doesn't require a monthly payment as long as one of them's living there. The loan is just deferred as soon as they sell or they both pass, then the loan would get paid off out of the proceeds and the rest goes to the heirs. So this line of credit, though, the way it's similar to a deferred annuity is it grows. And it grows contractually. There's a base growth that might be near, in that scenario, 3.5%, 4%. And then they add the 1-year Treasury index to that. So right now we could be growing at 8.5%, 9%. The 1 year's come down in the last month or so. So it's just growing contractually. And so their available borrowing power is getting bigger and bigger and bigger. So they get monthly statements. So their line of credit might have started at $270,000 on their $700,000 house, but it's getting bigger every month. And that line of credit is a bucket that can be annuitized at any point. And so day one, when we were sitting at the closing table, we could have turned on $1,700 a month for as long as they lived there. And so that check would just be coming and getting added to the loan balance and get paid off out of the house. Again, it's just a way to start utilizing housing wealth, same as we would use an IRA, but we haven't changed the house. And it doesn't matter if they're upside down. It doesn't matter if Mutual of Omaha goes out of business. The FHA is going to back up that payment. So it's very, very, reliable in that there's a lot of protections in place that money is coming to them, but they don't need it today. And so they let it alone. They let it grow. And as they get older, their withdrawal rate goes up and the balance, the line of credit gets bigger. And so when I showed them, I said, when you're 84, it's projected that you can take $4,300 a month for the rest of your life. And she kind of just fell back in her chair and was like, did you just hear that, to her husband? Because $4,300 a month when they're 84, tax-free coming to them, that gives them peace of mind, right? They know they're like, okay, right now, they're not accruing a loan balance other than the closing costs. So, if they don't utilize it, it's not that big of a deal. If they need to utilize it, though, they know that they can turn on money as soon as one of them passes and replace the Social Security. And so it's just that peace of mind. It's that insurance, the longevity insurance or long-term care, to where they know that they have this other bucket if they need it. And if they don't need it, it's housing wealth, right? It's all home equity that's going to get passed down. And so that's where we're adding the liquidity and to their largest asset. We're adding some liquidity. It's not 100%. We didn't give them access to the full $700,000 in value. We added some as a kind of a fail-safe or backstop. But again, that's so much more powerful by doing it now versus when they need it, because now you have it there and it's been growing all those years.
And I guess one question that I have is, so if you go through the process and say the property that they do this with, their last home, if they want to pass that property on to heirs, how does that process get managed with something like this?
So we're just a mortgage. We're just a lien on the property. So their estate plan is going to determine who inherits the property. What happens is once the last borrower permanently leaves, so passing being one way to permanently leave, the loan is due. So at that point, we say, okay, we need to get paid. And so we don't know when that date is, but at that point is when the loan's due. The heirs have 6 months to satisfy the loan.
Okay.
And so most, this is where this is one of those first questions is kind of, hey, if spouse A passes, do you plan to stay here, or do you think you would downsize? And then vice versa, right? If spouse B passes, and then what about the kids? How big of a goal is that? 9 out of 10 adult children don't want the home; they want the money out of the home. So they're like, no, my kids would sell it immediately. And so great. So they're going to put it on the market, sell, loan gets paid off, the rest is theirs. Because we're loaning so little percentage wise, there's a big margin of safety that there should be a lot of equity left, kind of depending on how long they've been there and the appreciation of housing and everything. But if it's upside down, it's a true non-recourse loan. So by law, we cannot come after any other assets. So it states we can only collect the lesser, whatever they owe or whatever it's worth. So they're upside down on a reverse. They pass, they have $1 million in the IRA. We can't touch it. They'll sign a deed in lieu, mail the keys, be done with the home. It has to be, they call it broom swept, which means get all your junk out, right? Have the estate sale, get everything out, sign a deed in lieu and mail the keys and be done with it. So, worst case, the debt is limited to the home, essentially, right? Okay. So it's worst case, you let go of the home. Best case, you sell it. If they want the home, they just have to satisfy the loan. So, they owe 200 if they want to refinance and pay that off. If they want to use other assets, that's fine. The loan is just due, is all.
Okay. Yeah. So
Yeah.
maybe an opportunity to do some life insurance planning or something like that to.
Yeah, you could. It's always, like I said, primarily the goal is primarily they don't want the home. If they want the home, it becomes a very different conversation. Because you are just racking up a bill that needs to get settled, and that's when maybe you do some life insurance planning. It's hard because you have a growing loan balance, so you don't know what that payoff's going to be. I talked to a client years ago that was like a third generation ranch in Montana. I was like, okay, so that was immediate like red flag of like, what's the plan here? And it's like, they do want it. And it was kind of, okay, if you pass today, there's 3 siblings, who's buying each other out? It's like, none of them could keep it. Even there's no mortgage on the property. None of them could keep it. They would have to sell it. So it's kind of, you have the desire and the reality are 2 different things too. But it's definitely part of the conversation for sure.
Yeah. So I would say, in terms of so we talked a bit about who's a good candidate. Who are people that you see that are typically not a good candidate for this that might be considering it?
Yeah, timeline is a big one. Like, how long are we planning on being in the home? Just because the closing costs are more expensive. So if you're going to sell in a year, it's not a good short-term loan. It's just not. It's meant for the long haul. It's cheap long-term care insurance. It's cheap income replacement insurance. It's very expensive. I need 50 grand for a year, right? That's not what it was made to do. So timeline's a big one. The other one is behavior. If you take those same clients we talked about and give someone a $270,000 line of credit and they go buy 3 sports cars, not that there's anything wrong with buying 3 sports cars if that's in the plan and meets their plan. It's not about the actual act, but the behavior behind it, right? Is it someone that can leave it alone for the purpose that it's there for, or is it someone that's going to blow it all? Because same with any financial tool, if you abuse it, it's not going to help, right? It's the same with credit cards or anything, right? Some people use it to their advantage, and some people it destroys their wealth. Reverse mortgages are certainly powerful to destroy your wealth if you use them improperly. And that's a big thing. I work with mostly financial planners, and we talk through clients, and they go, look, the reverse is perfect mathematically. It's going to solve their need. It's going to reduce their draw. I'm nervous they're just going to go spend it. They're just going to go waste it. And you're like, then kind of wait, because the advantage of having a mortgage is at least they're paying it, right? Behavior, at least they're actually saving. It's not a very efficient vehicle to save in, but at least they're actually doing it because they're not doing it anywhere else. And so behavior is really kind of my number one reason of not doing it. And it's tough because you can't always foresee everything. But yeah, that client that can't leave a bucket alone, unfortunately, they might not get the privilege of being able to do it, right? And we can't ever tell someone they can't do it, but that's where financial planners come in, where they can go, nope, right?
Yeah, you're gonna have to really lean on the relationship there of just like, hey, I know you, I know what you're gonna do,
right? Exactly, and we try to trust our advisors, and because legally we're bound to not discourage someone from applying.
Sure. So. Yeah. So for advisors who are looking to learn more about the process, how things work, what you guys do, what's a good place for them to get more resources, get more information, and connect with you, Mitch?
Yeah, they certainly can reach out to me. I love running scenarios. I geek out on retirement planning, retirement income planning. So it's never a bother to, hey, what about this client? What about this client? How could we structure this? Because even with my local advisors here, I kind of love meeting with the advisor first because it is such a multi-tool. And it gets overwhelming for clients because we can use this, the deferred annuity looks very different than paying off a mortgage. I mean, they're almost 2 different products entirely. And so going through or annuitizing at day one versus annuitizing down the line, and or setting up for long-term care, there's just so many different ways we kind of tinker with it and adjust it. And so it's easier to meet with the advisor and to understand, okay, is it qualified money we're pulling from? Are they on Social Security? Have they deferred that? What are we really looking at here? And we can kind of nerd out and get into the weeds to where we're only presenting 1 or 2 options to the client of like, here's where we see it. And the advisor can be like, okay, I really like this for them.
Yeah.
Because we do stuff where we turn on income for 3 years while we let the market recover and then turn the income back off. It's very flexible. And so getting into all that with clients, right? It's like you with taxes.
Yeah.
They just
Yeah.
want to know what's my return, or you're like, well, it's really neat because so at least we can nerd out on that. So, they can certainly email me at it's just first initial last name mcooper@mutualmortgage.com, and we can set up a time to Zoom and go through client scenarios. So
Yeah, that's great. So wherever, dear listener, you're encountering this media, we'll have the links nearby of how to get in touch with Mitch and his email address. Yeah. So any closing thoughts before we sign off?
no, just actually dive in to looking at housing wealth and take the time to learn about what's possible, because it's a lot more than I think people realize.
Yeah. And I think, if you've got those clients where, like you said, it's 60% of their wealth,
Yeah.
that's a huge space for you to add value in, if you haven't been paying attention to that before. But
Certainly to explore the options, right?
yeah, absolutely. Well, thank you so much for joining me. And for those of you who are listening, I'm always interested in getting your feedback. So please leave a comment, or however you're encountering this. I always love to hear what people think and thoughts and ideas for other episodes, and what you took away. So thanks for joining. And this was another episode of the Financial Advisors Want to Know podcast.